Let's get across the market open. Scott Phillips joining us from the Motley Fool. Scott, happy Friday. Now, we're getting some sign perhaps there's movement in regards to those tariffs. Well, certainly, obviously, as you'd expect, Donald Trump talking it up. The UK and the US, well, they haven't signed off on this deal, but certainly outlined the plan.
Yeah, they have, Andrew. Good morning. And this is a deal of sorts, mate. It is a deal, but again, think about the largely this is just press releases and populism, right? Let's break it down. The 10% tariff, 10% general tariff, still remains on UK exports to the US. What Keir Starmer managed to effectively negotiate, and Trump wanted was firstly, so Trump could say, "I did a deal. They came to me, see, I told you what would happen." But also some small changes. Aluminium and steel tariffs reduced. The UK is going to buy some Boeing aeroplanes. Car exports from the UK to the US will have a 10% rather than 25% tariff applied to them. So there's a few things that are moving around the edges. And yes, it's a deal of sorts. It's better than it was a day ago, a week ago, a month ago, but still much worse than it was 3 months ago. And that's kind of the key here. So when we talk about what the deal that's been done, it's not a deal to remove the tariffs, it's not a deal to meaningfully change them, frankly. The UK gets a little bit, US gets a little bit, and both leaders get to say, "See, I did a deal." So, is there economic benefit? Yes. It is much better than it was, as I said, a day, a week, a month ago, but still meaningfully worse than it was this time 3 months ago before the tariffs were unveiled.
All right. So obviously boosting equity markets globally. Locally, we're looking for a pretty much flat start. Look, investors here also focused on what we're hearing out of the earnings, particularly for the big banks this week. We've had Westpac, NAB, ANZ today, Macquarie Group.
Yeah, four of the big five. We talk about the big four. We really, Macquarie's moving so far and so fast into retail banking. At some point, we're going to talk about the big five, I suspect. Look, just on the markets, the US market was up about 1.2% overnight, ended up only being up about 0.6%. Lost half of that steam in the closing minutes, and our futures will look like we're going to get a better start than in the end we will. But you're right, the banks have been in focus this week. Pretty mediocre, I'm going to say. I don't mean to be offensive to any bank shareholders, but one profit was up 0.1%, one was down 1%, the other one was flat. I mean, it doesn't get flatter than that on average. CBA, of course, the big dog, we haven't heard from them. They report a different earnings cycle. So those three, I mean, good enough, kind of. Hard to hate the result, but hard to love the result in a tough banking market. The big challenge for the big three, or the big four eventually with CBA get reports, is generally speaking, what's supposed to happen? The theory, the economic theory, the textbooks we were all taught was that in times of rising interest rates, bank margins are supposed to improve. Why? Because you can charge more for your loans, you don't have to pay more for your deposits or your wholesale funding, and so you get that widening of those economic jaws, the net interest margin. That didn't happen in this latest upswing. Now we're on the other side of that. We've had the first rate cut. There may be another one in a week and a half's time. And so all of a sudden we're looking around and going, hang on, if you didn't make more money during the good times, what happens as rates then come back? You can't pay depositors much less than they're already getting. Wholesale funding will be a little bit cheaper, so you got that. But there are going to be some significant challenges, I think, for the margins, for general growth in terms of activity. It remains to be seen what happens with property prices. Maybe property prices jump again and that rescues the banks. But there's no surprise they're chasing business lending. They're looking at consumer lending thinking, well, we've kind of tapped that out. We're going to have to try and win some market share. And that's the other thing. The bank margins are flat to down again. So a really, really challenging time to be a bank CEO or a bank shareholder, frankly. Shane Elliott yesterday from ANZ, the departing CEO, said he made ANZ more boring, and that was a good thing. I tend to agree with him. Sold 30 non-core businesses, got out of doing business with some high risk. I think he said it was, high growth and high risk or something he called it. A very credible result. Banks, I agree with them, banks should be boring. So that was pretty good. Macquarie, on the other hand, never boring. Their profit up 5%, out this morning to 3.71 billion for the half year. A pretty good result for Macquarie, and up meaningfully on the previous quarter. So two good comparisons for the Millionaires Factory. Again, a bit of a complex business because of the moving parts Macquarie's got. It's always going to be a lumpy set of earnings, but roughly what the market was expecting, roughly what Macquarie had guided to expect. So a pretty good result. We'll see what happens when the shares trade. But for now, at least, I think, a pass mark, barely for the big three or three of the big four, and Macquarie getting back to some form. Still not at its peak, but growing again, which shareholders will be pretty happy with.
Just looking elsewhere, look, we do have News Corp and REA out today. What do you think about REA at the moment? Obviously, it has that dominance in its market.
Yeah, look, so a couple of things. Really, really great business. You're right, massively dominant. The classifieds businesses, we can't take them for granted now, but the just goes to continue to show their strength, even through the downturn. They were still minting money, making a fortune. So like REA, it's very expensive, I have to say, mate. I don't know. Well, I wouldn't bet on it growing to justify the valuation is my concern. So love the business, don't love the price. We've also got, of course, the domain deal that may or may not add some more competitive tension in the Australian market. So I wouldn't say cloud on the horizon. REA has taken all before it, and plenty of pretenders have come and gone. It's a bit like Seek. I don't remember the number of times that Seek has been said, oh, this business is going to kill Seek. That's going to kill Seek. It was going to be LinkedIn was going to kill it. Then it was going to be, Monster back in the day. And there's so many times they've been told someone's going to kill them. I don't think domain's going to kill REA, but I do think it'll add more competition to the market. It'll be interesting to see. This is one of the very few online marketplaces where you can actually have a healthy number one and number two because the price you're asking for the asset you're selling, effectively property, is so high, you'll happily spend up to perform on both platforms to maximize the number of potential buyers. That's not the case selling a car, not the case most of the time with jobs. I mean, you might post on Seek and LinkedIn, but realistically, they're the different markets. But so REA and domain can and probably will coexist. Whether there is tension on pricing, whether there's tension on market share, that remains to be seen. But really, really, really high quality business. And of course, news is largely, most of the earnings come from REA these days, or at least a decent chunk. So the News Corp numbers are largely a function of REA. It's not quite that strong, but not miles off it. A bit like Nine and Domain, frankly, the same sort of situation. So interesting to see how that number goes. The news business continues to be under pressure. Nine Entertainment was out a little while ago saying that things were improving on their TV business. Radio was not doing well, and publishing was pretty flat. News Corp numbers will be fascinating to see.
Scott, just to sum up, how would you assess the investment landscape here in Australia at the moment? Obviously, we've got the election out of the way. We've also heard from a number of companies this week with the Macquarie conference.
Yeah, and I think so. A couple of things, maybe my thoughts, Andrew. Firstly, tariffs continue to worry companies and investors, and I think, obviously broadly economically, but we've seen individual companies come out and say it's going to cost us this much, it's going to cost us that much. We've seen, Ford come out in the US and they've got put price of 3 cars up just this week. So the impact of those are still being felt, and a lot of companies are kind of downgrading or removing guidance just for the uncertainty of it, and that makes a whole lot of sense. So that kind of is, I think, hanging over the market a little bit. We don't yet know what that'll look like. In terms of sentiment, the other thing I think that is, it's almost the same thing. So you've got the companies themselves, and you've got investors who are worried about it. You've only got to see the size of the swings in the US. Not as much here, which has been lovely, but really big swings up and down when announcements are made and not made. As I said, even overnight, the market was up 1.2%, ended up closing up only 0.6. I mean, a win's a win, but it just goes to show how volatile sentiment is. And I think we're really seeing that sense of shoot first, ask questions later. And then the big relief rallies. The deal with the UK, I mean, it's meaningful. It's the first deal. It may well be indicative, but it didn't change that much, and yet the market jumped on that news, maybe because things aren't going to get worse, maybe because they're looking for some sort of return to normal, and that'd be lovely if it comes to pass. But yeah, really, the market is very jittery, I have to say. Again, I'll say as a long-term investor, I don't really care. I don't mean that in any nefarious way, just that, over time, these things will shake out. But it does make for interesting times. By the way, as a stock picker, it's a great time because you get a chance to look at stuff that's cheap and go and grab it when you can get it. We saw Warren Buffett's Berkshire Hathaway. Buffett, of course, saying he's going to resign from Berkshire. The shares fell 5% on Monday night trading our time, Monday daytime in the US. And that was largely kind of, I saw someone on Twitter say, what do people not expect he was 94 and might leave at some point or maybe even die? Like the market reactions are a little bit silly. Everyone knew Buffett was going to go at some point. A 5% fall on news that we all should have expected was silly. So that's great. If you're a stock picker, if you've got a bit of a stomach for volatility, it does provide opportunities, and that's, I think, the focus you have to keep.